In this video, we're going to look at whether you ought to be a fundamental analyst trader, a technical analyst trader, or both. And spoiler alert, I strongly believe it should be both. So when I first started learning how to trade, I decided to be a technical analyst trader. Like a lot of other traders, the idea of analyzing chart patterns just sounded a lot more fun and a lot more appealing than analyzing news data and economic releases. So what I discovered was that I was making really big wins using just technical analysis. However, on certain days when there was big news releases or pre-planned news data or unexpected news data, I would then make really big losses because I either didn't understand that they were coming up and that I shouldn't be trading if I didn't understand them. I didn't understand how they would affect the markets, and I didn't understand how to analyze the data or make sense of that. So what was happening was I was making big wins on technical analysis, and then I was giving it all back to the market on news days. So I put myself in for training on macroeconomics with institutional traders so I could better understand the relationship between fundamental analysis and technical analysis, and really why they had to work together rather than picking one or the other. So in this video, I'm going to talk you through what I learned, and if you are excited, hit the thumbs up button before we get started. And if you want to see more content like this, make sure to subscribe to Thinkmarkets now as well.
So what I was taught by institutional traders is that the economic data is the long-term direction and the short-term direction, and the technical analysis is your precise entries and exits. And as you can imagine, if you want to be a full-time professional trader, then obviously you need to understand all of those, not just 50% of them. So in this video, we're going to look at long-term direction, short-term direction, entries and exits, and how fundamental analysis and technical analysis is essential for all four of those. So the very first thing is long-term direction. If you think about it, the chart pattern is just a visual representation of the economy and the market that it's representing. So for example, we're currently on the US 30. So the US 30, the Dow Jones, is made up of the 30 top companies in the US. If those 30 companies are doing really well and they're releasing high earnings, then the US 30 is going to be showing on the chart that it's moving up. That's very logical and it makes perfect sense. If you were looking at a commodity like gold and the value of gold was going up, you would see on the chart that the chart pattern was going up. So the chart pattern long term is just a visual representation of how that market is doing in real life. But also we're going to quickly look at short-term direction, and then we're going to look at the relationship between the two, because the news releases, the economic data, pre-planned and also unexpected. When that news comes out, the very second that it comes out, the market has a very extreme reaction. So some of these are pre-planned. Like I mentioned, we've got CPI, NFP, interest rates decisions, those are the big ones, but also there is loads and loads and loads of pre-planned news releases which come out every day. Those are just the really big ones. And those are the ones that have such a big impact on the market. And we've got CPI on the chart right now. So when CPI was released, the second it was released, we saw a huge move in the market. And that's very common. So when the news is released, the exact second, huge move in the market. We don't know whether that's up or down. We just know the exact time of day that it's happening at. If you didn't know to check the economical calendar and to understand when it was going to be coming out, you might be in a weak position. You may also be stuck in a position wondering why the market's not moving. The market's not moving and it's not really giving you much because it's often indecisive in the run-up to pre-planned news data. So just knowing when the releases are going to be and planning around that is essential. Now, the other thing is how the short-term direction and the long-term direction relate. So we've got a lovely example up here. Let me just go to the day chart quickly and explain what's going on. So can you see that the US 30 overall has been making a nice move up? At the time of that CPI news release, we were in the middle of a big pullback on the day chart. So pullbacks are normal. You can see that these pullbacks have happened regularly throughout the market. It just means if the market was a little bit overextended at a certain point, the buyers were a little bit optimistic, the sellers sort of come in and rebalances it. And even when the market is moving up long term, you still get these pullbacks regularly from time to time. And we were in the middle of a big pullback. and the market was making a dramatic move down every day of that week. So we're just going to go back to the smaller time frame, and you will see that when the news was released, even though we were in the middle of a dramatic pullback, it was very positive for the US 30. So likely it was slightly negative for the dollar and therefore positive for the US 30. And we saw that the market made a dramatic move up the second that the news was released. So there was a lot of opportunity here. I'm just going to measure that move from the bottom to the top. That was nearly 400 points, 380-ish. So that is a huge move, lots of opportunity there, assuming you get in at the right point. We're going to get into entries and exits in a minute. And you can see that it then defaulted to the long-term direction. So the move down was even bigger. That was over 500 points, which is huge. And what tends to happen is if the short-term direction based on the news release that's just come out and the long-term direction, if they're in alignment and they're in the same direction, that's ideal, because then you'll see the market just going in one direction and often it just keeps going. But when they're out of alignment, you need to understand that too, because the second the news is released in the short term, you will see a move going in the direction of that news release before it defaults to where it was with long-term momentum. So you always want to be aware of what the long-term direction is, what's happening on the day chart, where momentum is on the day chart, when the news releases are coming out short term, how that relates short term, and what you can expect from it short term, and are they the same or are they different? Because you're going to get a very different situation depending on that. And we can see a great example here of when they were in different directions. And this is just a beautiful example of what the market tends to do when that happens. So entries and exits. As you've seen, we had a huge move up, which was nearly 400 points, and a huge move down, which was over 500 points. Both enormous moves. But can you also see how if you entered at the wrong points, then you would actually lose a lot of money? So can you see if you entered down here, yeah, you had the potential to make nearly 400 points. But can you also see how if you waited for a little bit, perhaps you entered up here, you would have lost, let's just say, I don't know how big your stop loss would be. I usually take a stop loss of about 30 points on the US 30. So yeah, that would have hit pretty quickly. And to being able to survive the pullback that happened, I mean, you would never have a stop loss that big, because that's as big as your take profit really ought to be on this, which means that you would have taken a loss on this if you'd entered at the wrong point. And if you'd kept re-entering, perhaps you waited for another confirmation, you saw this big candle here, and you entered again, that would have been another loss. You could have taken several losses on the way up, all with the right direction. But if you weren't entering at the right point, then you would have just taken loss after loss after loss, when in fact there was actually a lot of potential to make a big win there. That's why trading is so difficult, because you can get the direction right and you can still make so many losses because you're not entering at the right point. So entries are so important, and that's really why you need to be so good at technical analysis. So understanding the fundamental analysis to know the long-term direction, the short-term direction, the times that the market's going to be moving at, it's likely to be moving at, but then your precision of entry and exit is often to do with technical analysis. And what a lot of traders like to do is they like to wait for a pullback and then perhaps a second confirmation, like an engulfing candle, before entry. And that means that they are avoiding these big pullbacks because they're waiting until they have already happened. And another thing that traders like to do is use key levels or the Fibonacci retracement and look for specific points to enter in on if they see confirmation at those points.
So now you understand why I strongly believe that using technical analysis and fundamental analysis is stronger together. If this resonated with you and you'd like to start incorporating fundamentals into your trading strategy, then the next step is to keep an eye on the economical calendar on Thinkmarkets and make sure you're aware of the days of the week when the news releases are coming out, how high impact they are, and the time of day that they are scheduled to be released at. Also, I've made previous videos on Thinkmarkets YouTube channel going into how to do fundamental analysis in more detail. So if you want to learn more, then make sure to watch that video next. If you found this video helpful, give it a little thumbs up. And if you want to see more content like this, make sure to subscribe to Thinkmarkets now as well.